Step bro, I love you. This is a heart. See it? I love you, step bro. Welcome back to Strongman Personal Finance, everybody. My name is Christopher Belli. I'm a certified CPA accountant. I'm a long-term bobblehead investor. I'm author of the book, Stop Being a Broke Loser. It's on Amazon. And guess what I'm going to do today? I'm doing some work for my handsome step bro, Meet Kevin, who I formerly used to call Meat Breath. But he actually told me he brushes his teeth, so I was wrong. Anyway, welcome back to Strongman Personal Finance. Today, we're going to do an introductory screener analysis of Adobe Stock, PDFs, all sorts of other crap they do. And then later on, I'm going to do a way more in-depth analysis of the company as a whole, because I have been compensated to do this, and I'm not just going to make one crappy video for my handsome step bro, okay? So first of all, I want to give you my initial impressions of what I think Adobe is as a fair value to get a 15% return, and we'll look at different metrics. So what we're going to do is we're going to pull up my trusty dusty tool that I made myself, and we're going to see if Adobe's a good deal. Maybe it is, maybe it isn't. I actually have not looked at this at all. I have no idea. I have no preconceived biases. I've never thought about Adobe stock. I mean, I've thought about Adobe, obviously. I use it all the time. And we'll see. So let's go ahead and share my screen. Okay, screen shared. Let's go look at Adobe Nairobi. So first of all, we can see Adobe has had a little bit of a correction. Scroll down a little bit. And forgive me, I hate Macs and I suck at them. So over the past year, Adobe had a pretty massive run up, and it went as high as, looks like, 688. And now it's all the way down to 417. So a lot of people may be thinking it's now a buy, but just because a stock goes down, even massively, doesn't mean it's a good deal, because it could have been massively overvalued before. So this is Jeremy's logic, by the way. So let's go ahead and punch in some numbers into my model, and let's see how this works. So the first thing I do is I find the trailing 12-month revenue. Okay, trailing 12 months. We have $15.785 billion. Ooh, this shares outstanding. 15,785,000,000. Next, oh, it's a buy at 38, guys. Next, we need to see the shares outstanding. So always remember, when a company has profits, those profits are basically split up between all of the shares that are outstanding, held by the public. So the less shares there are, the more the profits you get. The more shares there are, the less of the profits you get. That's kind of how it works. So we can see that they currently have 481 million shares outstanding. It's not a lot, okay? 481 milli. Okay. Now, let's look at revenue growth. How fast is Adobe Nairobi's revenue going to grow? Now, we can see in the past, quarterly year-over-year revenue growth, it's been growing at about 20%. 20, 15, 14, 20, 20. Now, because this company is going to be more mature going into the future, I'm not going to use 20%. I'm going to use a number that's less. So I'm going to say 18%. So let's go with 18% revenue growth. Next, we need to look at the profit margin. How profitable is this company? Margins. Okay. They're probably very profitable with that stock price. So it looks like they were not very profitable in 2014, and then their profitability has steadily risen. Then they had a spike in late 2020, and now it's come back down to normal. So if you kind of look at the average over here, this is kind of a tough one. I'm going to say we'll go with 30%. Okay, you can see it was in the 20s, and then it's, high 20s, low 30s. Then it had a temporary spike, and now it's coming back down to earth. So this is a reason you need to do more analysis on companies like this, because the company may actually be doing things to improve its margins, which will change your analysis. But what I like to do is just look at the past and say, okay, roughly what has the profit margin been? What's the rough trend? Because then I can use that to project future profitability. So we'll be nice to my handsome stepper and we'll say 30%. Okay. PE at disposition. What is Adobe's price to earning ratio right now? Price ratios. Okay, Adobe's PE as of April is $39. So you got to think in 5 years, what could Adobe's PE ratio be? That's kind of, this is always the tough one. I like to be conservative. I'll give it 25. Okay, because that is, it's not super high, but it's also not super low either. It is a pretty decently fast growing company. And remember, the higher you assume your PE is, look at the buy price at the bottom. The higher your PE, better the buy price is. Okay. I mean, right now it's probably a buy if you think it's going to be a 30 PE. So let's see. What is the share price right now? Let's go look. Adobe stock share price. Oh, it's at 408 right now. So I'm going to say you're going to have a 25 PE at disposition. Now let's look at share buybacks. Are they actually buying back shares? Are shares going up or shares going down? So it looks like shares are going down, and it looks like roughly 1%. 1%. So we'll use negative 1%. Okay. So here we have our initial numbers. We got trailing 12-month revenue of $15.7 billion. We have 481 million shares outstanding. We have a 15% rate of return. That's what we want. Revenue growth, 18%. Profit margin, 30. I think that's reasonable. PE at disposition, 25. And share dilution, they're buying back shares. So looking at this, the company is not a extremely bad deal right now. I've seen way worse. Just go watch Financial Education. Now, let's say we want a 10% rate of return. It's a buy right now, in my opinion. I mean, don't take this as financial advice because this is just a very simple model. But if you look at it, this is more attractive than other stocks that I've looked at, like Tattoo Truckers Taint and Corsair My Borsair and Honest My Bonest. This is not a horrible deal. Now, you got to be careful because if revenue gets lower, let's say revenue actually doesn't do as well as you think. Let's say it matures faster and we get 15% revenue growth and the PE is 20 at disposition. Now it's not such a good deal, okay? So to me, I don't know. I would probably wait until this stock got down to the 200s before I really considered buying it. I know I'm super conservative, but I don't buy individual stocks unless I think I'm going to get a screaming deal. So I would say probably in the mid to high 200s, you might be getting a good deal. Not that I'm saying it's bad now. I mean, if they do 20% revenue and their PE at disposition is 25, it's close. It's very, very, very close. So not bad. Be careful with this stock. I would maybe wait until it goes down a lot more because it's highly possible. Interest rates keep going up, which they will be, and the market crashes, you might be able to get this stock at a screaming deal. So I would seriously, once the stock dipped below $300, I would relook at it, do a lot more analysis, and really consider if it's a good deal because it's not that bad of a deal. Highly profitable, pretty decent revenue growth. I think they do have a strong moat. There is no alternative to PDF that I know of. So that's my initial thoughts, Step Bro. I probably wouldn't buy it now, but I know you like your risk. You like being a risky boy. You probably think the PE is going to be 30, don't you? Oh, yeah. 30 PE, it's a buy right now. Anyway, that's it. Let's see some comments. What do y'all think? Are y'all buying Adobe Nairobi? Just check my phone at the right time. Of course. 25 PE is too high. Yeah, it probably is. I mean, the revenue is decently high. I would probably use 20 because it's not, the average of the market is 15. And that company is growing its revenue faster than I think than the economy and the market as a whole. So maybe 20. If you want to be super conservative, you could use 15. I actually expected the fair value to be quite a bit lower. So the price that's on there is the price that you want to buy it at to get that return. So when I did let's go back real quick. I mean, my honest to God opinion of when I would buy this stock, I would do 20 PE. I would do 18% revenue growth. Yeah, I'd probably buy it in the middle to high 200s. But as of right now, if it's trading at 400, it's still a little bit too expensive for me. So, yeah, but this is your buy point. You say, if it dips to this point, this is what I would do. If I saw Adobe went below 290, I would say, okay, I'm buying it. And whatever happens after that, it keeps going down. Okay, you can't predict the future, but at least you know at that specific buy point, you're probably getting a good deal. So I would probably buy it in the high 200s. My opinion. My opinion, bro. Or you can just buy index funds. Don't worry about it. Buy my program, bro. Yeah, I make this crappy model on Excel and I can charge people $1,000. What is PE disposition? So what that means is the model says you buy the stock, you collect the earnings for 5 years, and then you sell it. And the PE disposition means you're selling it. So you have to look and say, okay, what would the share price be when I sell the stock? That's basically what the model is calculating. So when you sell the stock, think about cash flows. You buy the stock, you're getting earnings every year. And then when you sell the stock, you get that big influx of cash because you sold the stock. So that's a part of your return is how much you're able to sell the stock for. So that's that. Just tuned in. Can I get a rear? What am I going to burn Chris Sane again? I don't know. Maybe later this week. Adobe might be the next PayPal Netflix style crash. Yeah, right now I wouldn't buy it. In my opinion. I mean, it might go back up. I don't know. But I like to be safe. If B. Kevin likes it, it's overpriced. Can you do Neo stock? Are they even profitable? Honestly, like I'm not great at analyzing stocks. I don't make money. It's just hard for me. Can you give Luis a shout out? She's a big fan. Who's Elise? Luis. Wow, Adobe my Obi. Well, that's it. Yeah, I'd probably buy it in the 200s. 270, 250, something like that. But y'all be careful out there. Okay, you see like these models are great because they just screen out automatically. Is Adobe too expensive? Yes. Maybe I should wait. Okay. Maybe I'll look at another stock or maybe I'll just buy an index fund. It's not hard, ladies and gentlemen. All right, that's it. I will talk to y'all later. You should be on my text. I'm saying America, boy. Anyway, talk to you later. Cheers.